Interest rates are currently at historic lows, in case you hadn't noticed. The Federal Reserve has dropped its main interest rate to 0.25%, which is nearly as low as it gets. Banks have followed suit, and the average savings account now pays a 0.06% annual percentage yield. While there are a few high-yield bank accounts that provide rates slightly higher than this, bank deposits will not earn you anything in the way of interest. Fortunately, increasing your profits without increasing your risk is not impossible. But what are the things you should think about? Please keep on watching for additional information on this, as well as today's topic of the best low-risk investments right now. This is the Ticket to Financial Freedom, Financial and Investment Wisdom. Please subscribe to the channel and switch on notifications to receive updates of new uploads. So what should you think about when it comes to investments? There are a few situations that could play out depending on how much risk you're prepared to take. The first scenario is the no-risk scenario, in which you will never lose a single cent of your initial investment. The second scenario has some risk. It's acceptable to assume you'll break even or lose a little amount of money over time. However, there are two drawbacks. Low-risk assets produce lower returns than riskier investments, and inflation can reduce the purchasing power of money held in low-risk investments. If you simply invest in low-risk assets, your purchasing power will erode over time. It's also why low-risk bets are better for short-term investments or putting money aside for an emergency fund. Bigger risk investments, on the other hand, are better suited for higher long-term returns. Let's get started with our best low-risk investments list. High-yield savings accounts are first on our list. Savings accounts, while not technically an investment, provide a modest return on your money. You can find the highest yielding options by searching online, and if you're prepared to look at the rate tables and shop around, you can obtain a bit more yield. Why should you put your money here? In the sense that you will never lose money, a savings account is absolutely safe. Most accounts are insured by the government up to $250,000 per account type per bank, so even if the financial institution fails, you'll be compensated. The risk here is that while cash may lose its purchasing power due to inflation, it does not lose its dollar worth. If high-yield savings accounts aren't for you, then perhaps savings bonds are. Savings bonds in the United States, like savings accounts, aren't strictly speaking investments. Instead, they're savings instruments, according to Michaela Braden, a former senior counselor for the U.S. Treasury Department. TreasuryDirect.gov is run by the Department of the Treasury. The Treasury sells two types of savings bonds through Treasury Direct: the EE bond and the I bond. The I bond is a good choice for inflation protection since you receive a fixed rate plus an inflation rate added to it every 6 months, Braden adds, referring to a twice-yearly inflation premium. Why should you invest? Series EE savings bonds pay interest for up to 30 years and have a set rate of return if purchased after May 2005. A penalty equal to the final 3 months' interest is charged if a U.S. savings bond is redeemed before 5 years. Concerned about the risk? Savings bonds in the United States, on the other hand, carry little to no risk and may yield little or no return. As a result, your purchasing power is likely to erode over time. You should also think about certificates of deposit. Unless you take the money out early, bank CDs are always loss-proof in an FDIC-backed account. You should search around online and compare what banks have to offer to discover the best rates. Why should you put your money here? If you keep the CD until the end of the term, the bank guarantees to pay you a certain rate of interest for the duration of the term. Some savings accounts provide higher interest rates than CDs, but these so-called high-yield accounts may need a substantial deposit. In terms of risk, if you take money out of a CD too soon, you'll likely lose some of the interest you've earned. Some banks will also charge you a fee if you lose a portion of your principal. So study the restrictions and compare rates before you buy a CD. Let's discuss money market funds. Money market funds are pools of CDs, short-term bonds, and other low-risk investments that are sold by brokerage firms and mutual fund companies to diversify risk. Why should you put your money here? A money market fund, unlike a CD, is liquid, which means you can normally withdraw your cash at any time without incurring penalties. Let's talk about the risk now. Money market funds, according to Ben Wasick, founder and financial counselor of Guide Financial Planning in Minneapolis, are usually fairly safe. Treasury bills, notes, bonds, and TIPS are all low-risk investments right now. Treasury bills, Treasury notes, Treasury bonds, and Treasury inflation-protected securities, or TIPS, are all issued by the U.S. Treasury. Treasury notes have a 1-year or shorter maturity period. Treasury bills can last up to 10 years. Treasury bonds have a maximum maturity of 30 years. TIPS are investments whose principal value fluctuates with the direction of inflation. Why invest here? Well, all of these securities are very liquid and can be purchased and sold directly or through mutual funds. If you're concerned about the risk, you won't lose money if you hold treasuries until they mature, unless you buy a negative yielding bond. If you sell them before they mature, you risk losing some of your principals because the value fluctuates with interest rates. However, due to recent market volatility and the Federal Reserve's decision to cut interest rates to zero, some treasuries may have a negative yield. As a result, some of these bonds may end up costing you money. Okay, before we go ahead and discuss the remaining low-risk investments right now, please make sure to hit the thumbs up button and feel free to share your thoughts in the comments section down below. Let's return to the list and discuss corporate bonds. Corporations can also issue bonds, which range from relatively low-risk bonds issued by huge profitable companies to very dangerous bonds issued by very risky companies. High-yield bonds, also known as junk bonds, are the lowest of the low. There are low-rate, low-quality, high-yield corporate bonds, explains Cheryl Kruger of Growing Fortunes Financial Partners in Schaumburg, Illinois. I think those are riskier because you're dealing with not only interest rate risk, but also default risk. The market value of a bond might fluctuate as interest rates change, which is the interest rate risk. Bond values rise when interest rates decrease and fall when interest rates rise. While the default risk is that the corporation may fail to make interest and principal payments as promised, ultimately leaving you with nothing on your investment. Why should you put your money here? Investors can choose bonds that mature in the next several years to reduce interest rate risk. Longer-term bonds are more susceptible to interest rate movements. Investing in high-quality bonds from reputed multinational corporations or buying funds that invest in a broad portfolio of these bonds can help reduce default risk. Let's talk about dividend-paying stocks now. Stocks aren't as safe as cash, savings accounts, or government bonds, but they're safer than high-risk investments like options and futures. Dividend companies are thought to be safer than high-growth equities since they produce cash dividends, reducing but not eliminating volatility. As a result, dividend stocks will fluctuate with the market, but when the market is down, they may not fall as much. Why should you put your money here? Dividend-paying stocks are thought to be less hazardous than those that do not. I wouldn't call a dividend-paying stock a low-risk investment, Wasick says, since there were dividend-paying stocks that lost 20% or 30% in 2008. However, it has a smaller risk than a growth stock. Next, we'll look at preferred stocks. Preferred equities have a lower credit rating than regular stocks. Even so, if the market collapses or interest rates rise, their prices may change dramatically. Why should you put your money here? Preferred stock, like a bond, pays a regular cash dividend. Companies that issue preferred stock, on the other hand, may be entitled to suspend the dividend in particular circumstances, albeit they must normally make up any missing payments. In addition, before dividends may be paid to common stockholders, the corporation must pay preferred stock distributions. Money market accounts are another option to investigate. A money market account resembles a savings account in appearance and features many of the same features, such as a debit card and interest payments. A money market account, on the other hand, may have a greater minimum deposit than a savings account. Why should you put your money here? Money market accounts may provide higher interest rates than equivalent savings accounts. You'll also have the freedom to spend the money if you need it, though the money market account, like a savings account, may have a monthly withdrawal limit. You'll want to look for the greatest prices here to make sure you're getting the most out of your money. Last but not least, there are fixed annuities. An annuity is a contract usually negotiated with an insurance company that promises to pay a set amount of money over a set period of time in exchange for a lump sum payment. The annuity can be structured in a variety of ways, such as paying over a certain amount of time, such as 20 years or until the client's death. A fixed annuity is a contract that promises to pay a set amount of money over a set period of time, usually monthly. You can contribute a lump sum and start receiving payments right away, or you can pay into it over time and have the annuity start paying out at a later date. Why should you put your money here? A fixed annuity can provide you with a guaranteed income and return, which can help you feel more secure financially, especially if you are no longer working. And that's it for today's video. If you want more content like this, please make sure to subscribe to the channel and turn on the notifications to be notified of every new upload. This is Financial and Investment Wisdom, and we'll see you in our next video.